what I wanted to talk about was something that I did mention back in December, if anyone watches my sort of quite regular mentor session stream, as something that potentially was going to come about with this shift in Eurex to allow an overnight trade. So Eurex now has, previously they used to trade from 7 in the morning until 9 p.m. That was the trading hours of the futures. That was all you could trade. Now, in certain products, DAX, Eurostox, Bunds, Bobbles, Shats, I believe, so the main core products, they are now allowing overnight trade, which basically runs from midnight through to 9 p.m. So you end up with only about a 3-hour shut time. Now, this then produces potential for a trade that's similar to something that a lot of people I know look at in the S&P. And my fear initially was that volume was particularly low. Volume's not changed, but the structure of this trade does seem to be playing out a little bit more at the moment. This could be a symptom of time, that we're just happening to be doing it at the minute. But once you've learnt the trade, once you get the trade idea, if this stops working for a little while or doesn't present the opportunity, step away from it. You don't have to take it. But it's all about having that in your playbook, having that as a tool that you can use. That way, when it does come around, you've got a trade. So, talk you through the idea of this trade. What I've got in these little boxed areas, and I'll show you it on another chart a little bit lower, which has got slightly less range in it, which makes it a little bit easier to see. This one's in the DAX, and we've got a range of 11,000 up to 11,300, so big range. But what you're looking at is these little boxed areas, just here, and just here. That's your overnight range. So that's the range from midnight until 7 a.m. the traditional futures open, and you can see that's where the volume starts coming back in. Not huge, but the volume starts coming in from 7, and then it continues once the cash opens at 8. Times here, I'm talking UK times. Once cash opens at 8, then we get the sort of pick up in volume and then the beginning of any further movement. So what are we looking at in this trade? Well, what you're looking at is the move in the overnight session to be skewed, i.e. majority in one direction. So what this is showing you is then that people who've got themselves positioned in this very low volume, very low liquidity, so really not a great deal of positioning, have all got themselves skewed net in one direction. So that's the close from the day before, just here. We then trade below that overnight. Almost no trade at all at the close. So what that's suggesting is that net positioning is short. There's been more selling than buying to get the market down there. I'm not talking about delta in terms of whether the sellers have been more active than the buyers. I'm talking just in terms of there must be more sellers to get the market down. So net positioning is short. Now what you're looking at in this trade, and in this instance, we got a small amount of trade, and this is a 15-minute chart, small amount of trade just below the close, but then the majority once more up above. So net position here is long. What we're looking for then is these positions want to see continuation. If they don't, do we have a trade? And yes, we do have a trade on it. The question is, how do you execute this trade? Because it's all well and good to saying, yeah, we've got a trade. You've got to find a way into this trade, because just looking at this and saying to yourself, right, well, it's been selling overnight, so we should turn this round, can end up getting you in a position where you keep buying it all morning, possibly all day, and the market keeps going. Just because it's selling overnight, it doesn't have to turn. So you need a way of playing it. The way I'd be looking at this then, this is the previous day's low, the red line. In this instance, the previous day's high. So the red's the previous day. The blue is the open of the 7 o'clock. So the sort of when the volume really comes back in. The way I'd be looking to take this trade on is, you see here, fails to keep going. We do stay below the open, below the overnight low for a period of time, but as soon as you're back through the blue line, back through the open, you're then looking for a turnaround. And target wise, this I don't think predicts this, and that would be a mistake, I think, in trying to look back at something like this and say, oh, it's set up this move. I don't think it has at all. What is set up is a move back to fill the gap, and if you want, to fill the close gap as well. So you'd be quite happy with that for a target. Back through the open, you're getting in just below 50. If you take it all the way to the close gap, you're getting just below double O's. So it's around about a 50 tick move. So that's the principle of the trade, basically, that it turns over the overnight trade. Again, up here, this comes straight from the open. The open just sells straight off, which is slightly difficult. It does have a marginal tick up, and that's where it does become a little bit of a difficult trade, and sometimes the trade's not actually playable as such, because the speed with which it turns straight from the open makes it quite a tough one. If you sold it on the assumption that the move in the overnight is not going to continue, then you did still get quite a quick move back to the gap, but that I think is quite a dangerous trade. So we'll move on, try and make it a little bit clearer, and then I've got sort of trade criteria below here. So these are the things that I'm looking for in order to be interested in taking this type of trade. What you want to see is we need a gap out of range. So what that means is that the overnight trade has taken the market outside the range of the previous day. So you see here, previous day's high, the red, in this case previous day's low, the red, that the overnight trade has taken us beyond that by the time we open. So by the time you get the blue line. So we're opening with a gap, tick. Majority of trade is one side of the close. This is that skewed positioning. We've got the close down here. In this case, everything is above the close. All trade that takes place is above the close. And then we get this continuation up. Tick. So this, once you've got those two elements, they're your criteria. They're the bits that say, right, it's time to look for this. It's worth having a look. So you've now got to decide how you're going to execute this trade. It's one thing to look for it, the other thing is then to execute it. So what you need to see is a failure to move beyond the overnight extreme, either a failure to get there or a failure once it goes through it to keep on going. So in this instance, and I have made a little mistake there, that the open's actually up here, where I've drawn my blue line. In this instance, we open, we test up very briefly, can't make the overnight high, and then start to fall. From this point of view, you're then looking at that thinking, right, this is good. We've not broken the overnight high. We've got positioning long. I can now start looking for a short. We start to drop down, and you've got a couple of ways of playing this. Either you've got the move back through the open, which is very tough to get on. With this first candle closing down here, you could look for a short with a stop above the overnight high, which in this instance is giving you around about 15 tick stop, which is quite big. Target wise, you're looking down towards double O, so you've got about a 25 tick target and a 15 tick stop. Alternatively, you're looking to play it out of the initial balance, so out of that first hour's trade, to then go and try and fill the gap, or at least through the overnight range. We only get as far as the overnight lows, so this is a bit of a tricky one. But in terms of the first gap, so the price gap, the high of the previous day, if you get on the reverse early on, and one little thing that I would be looking at, this last little move up, that's the last 15 minutes before the 7 o'clock open. That looks like a bit of a squeeze, a bit of a push. You know, we've seen very, very stable range prior to the open, and then a late push up. there's not going to be a great deal of people in this move, and anyone who is buying that is going to be thinking to themselves, I need to get out of this. If this doesn't keep going, I'm out, which I think is why you get that quick move down. So I would suggest there is actually value in selling the 7 o'clock here. You'd sell the open with a stop above the high, looking for at least these positions to get taken out. And then also, taking these positions out takes you right the way back to the previous day's high. Alternative look, and this was yesterday's move. There's previous day's range, low, 12 o'clock open, small tick up, and then all trade down lower. So again, we're getting a gap below the previous day's range, and all trade down here. So again, once more, what you're looking for is failure to break the overnight range, and then for a trade execution, a move back through the open, so back above the blue. Once you get through the open, you've got a target up towards the previous day's low, which also in this instance happens to be the close as well. So you've now got a target straight the way up there. You're buying it from around about 35s, and you've got a target up at around 65. So it's giving you quite a decent little target there. What's particularly useful is the fact that it comes back and gives you a chance to buy the open, and then the open stays for the rest of the day. In fact, that level was 37s. So that's the premise of the trade. The idea is that the trade in the overnight session can't sustain a move. It's weak positioning. It's done on virtually no change in delta, virtually no volume. Therefore, the only way that this is going to keep going is we need people to come and sell it. Any sign that this isn't going down, people who are in these positions short are going to start coming out. You don't get large participants, institutional buyers, sellers that are going to come in the overnight session when there's no liquidity. Therefore, it's a reasonable assumption that these aren't particularly strong positions. These are people trying to take advantage of a short-term move, and if they don't get the continuation of the move, they're going to come out. Doesn't mean they're fools. Don't think about it like that. You know, these are people, these are your day traders. Some day traders are very, very successful, and they're taking advantage of some part of the move, but ultimately, if you're a day trader, you're not holding on to this if it doesn't keep going. Effectively being short here, what you're looking for is the market to keep going in that direction. If it doesn't, you're out. You're going to come out of it quite quickly, and that's where you get that reversal from.